Now 11.25 is our prelim analytical, and very simply what we've tried to do on this working paper is we're trying to replicate what you should be seeing on your financial statements. So please just do go and verify that we are actually getting the values correct on the financial statements, or from the financial statements. We do replicate the formulas, but if you've got any unusual linking, it could result in slight variances on this working paper. But here is my balance sheet, and it's followed as well by my detailed income statement. We then also it's calculating a variance, and wherever this variance is greater than 10%, we immediately go and highlight under Action 3 that we're wanting to go and get management comment for this deviation above 10%. Now, it's not necessary to go and maybe document under every line item. Maybe if we go and have a look under current liabilities, you've got 3 items here with a greater than 10% movement. If you feel it's appropriate to document it just under the total current liabilities line, go and do that. You can document that difference. Just make sure you're covering all aspects of it. And at the end of the day, what we're also looking for is, are we identifying a risk? That's again the purpose of my prelim analytical. So if I sort of have a look at this document from an auditor's perspective, I look at a line item like my trade and other receivables. It's gone from 20 million to 64 million, a 222% rise. Immediately I should be thinking, do I have a recoverability risk here? Is my debtors maybe overstated? Have I overstated my revenue by putting through fictitious sales? What is the issues that this sudden jump could result in? But before we do that, we're discussing it with management. Management, what's happened in trade and other receivables for the year? Well, maybe they've suddenly started giving new credit to government. They've obtained a large government contract, and we know government is slow to pay, so maybe that is sufficient reason for me to lower my consideration of what that risk is. And I'd rather go and say, well, it's not a fraud risk, so I'm not thinking there's an intentional overstatement here, but from a business point of view, I just want to go and make sure that what management is telling me is actually meaningful. Is it correct? Or is there actually only R1 million government debtors at year end, so that doesn't cause a problem in terms, so the management's response is not appropriate to say that it's because of government that the debtors have increased so much. Once we recognize a risk, once again we need to go and identify whether it is a business or a fraud risk. Okay. We've also included a ratios sheet. And in the ratios, we've once again tried to just go and pull in some of the most common ratios that one would generally calculate from an audit point of view. We're giving a spot to go and get management's comments on the movements in the ratios. And then once again, we're looking for, are we identifying any risks? That's the process. Once again, we're just looking for risks. If I scroll down a little bit further, I'm going to go and just have a look at something we added recently, which is the Altman Z-score, something I studied when I was at varsity, so some of you may be aware of what the Altman Z-score is. The Altman Z-score is basically a little bit of a predictor of insolvency, basically bankruptcy of companies. It was written in 1968 by Edward Altman, and there's a little hyperlink there to go and have a look at the Wikipedia discussion on what the Altman Z-score is. But they're talking about an 80 to 90% accuracy in predicting bankruptcy 1 year after the event. So in other words, within the next financial year. And it goes and calculates various ratios. It goes and has a look at what and distinguishes between safe, grey and distress zones for the business. There are 3 variations of the calculation. You will see that there are green input cells. So for instance, we need to go and insert the market value of equity. Go and have a look at it, go and read it. If you don't like it, if you don't want to use it, just close it, then it will not form part of your working paper. But it's a nice little calculation to go and consider, are we looking at a company that is undergoing concern distress and therefore Do we need to go and reconsider our going concern assumption? Or do we maybe need to actually look at some sort of a qualification indicating that there is instability in the company? Now, obviously, this isn't the point at which we decide what the report is. This is about identifying those risks. We will assess and test those risks when we execute our audit at the end of the day.